Hello, everyone. This is Brooke, DeFi analyst from TID Research, and then in today's, I'd like to talk about two interesting protocol that issues a very interesting yield-bearing stablecoin. Yeah, the architecture of yield-bearing stablecoin is actually shifting very fast. For the past year, the industry standard has been to back stablecoin with tokenized US Treasury bills, but as DeFi searches for higher and more sustainable returns, protocol are now tapping directly into a very interesting new asset classes, which is public corporate balance sheet. Specifically, they are leveraging Digital Asset Treasury's company, which is DAT. Public companies, they hold massive of cryptocurrencies such as BTC, ETH, or Solana. Today, we're analyzing these two protocols leading this kind of transition, Saturn and APYX. We'll look at how they source their yield, how they differ in structure, and why both protocol might actually just be another synthetic over-collateralized Bitcoin-backed stablecoins placed in disguise. So let's first start with the Saturn, which currently serves as a foundational model for this kind of new asset class. Saturn operates a dual token system featuring a base stablecoin, which is the USD, and it is non-yield bearing, and also the SUSD-AT. USD-AT is pretty straightforward. It's 100% backed by the US Treasuries. However, for SUSD-AT, it has a target yield of 11%. And to generate its target yield, Saturn backs the SUSD-AT with the very, very interesting instrument called STRC. So what exactly is STRC? STRC is a public traded perpetual preferred stock issued by Strategy or MicroStrategy, which is a digital asset company holding a lot of BTC. And here is how the mechanism of STRC works. Strategy issue these preferred shares to the public market to raise capital, which then they use to continuously buy more Bitcoin. In exchange for providing that capital, investors holding the STRC receive a high variable dividend payout, which is around 11.5%. So this is exactly how SUSD-AT generate their yield. Saturn essentially takes this traditional institutional grade credit instrument and bring it on-chain. It turns Strategy's corporate treasury into a DeFi yield engine. By utilizing dynamic reserve management, which is using the tokenized US Treasury bills to back the USD-AT to guarantee the stability of the asset, and then using the STRC to back the SUSD-AT to generate yield. The protocol maximizes the exposure to this STRC dividend premium during the favorable market condition, while expect the user to shift the asset, unwind the asset, and move back toward T-bills to hold USD-AT to defend the coin pack during drawdowns. And that is how it's working. And then the Saturn has been doing pretty good as of now. It just received the investment from the YC Labs. And then the wait list is getting longer and longer. And then the Pretty Parts program is also pretty popular among the OG DeFi farmers. And then it's been announced another round of the financing from the Tier 1 VC. So that's for the Saturn. And now we can look at APYX. So for APYX, if Saturn is the pioneer of this model, APYX can be viewed as a more sophisticated or more advanced version of this dividend share back yield bearing stable. So instead of concentrating risk into a single corporate entity like MicroStrategy, diversify their basket of the preferred equity from multiple DAT. The logic here is actually pretty straightforward. By holding a basket of dividend-paying shares from various public companies that is holding the crypto, APYS mitigates single entity failures, for example, from the strategy. If one company alters its dividend policy or faces operational hurdles or any regulatory crackdown, the broader basket sustains and therefore protect the team. It takes the core concept of capturing traditional financial cash flows and scale it horizontally to reduce the isolated counterparty risk. So what exactly is APYX is holding right now? So we're still at a very early stage of the APYX, and then you can see that the expected APY is also around 13%. So it means that for APYX, right now it is also holding the STRC from Strategy. But on top of it is also holding the similar kind of preferred share with the perpetual dividend payout from Stripe, which is another BTC digital asset companies listed on Nasdaq. And in the future, APYX is planning to hold not only the BTC Digital Treasury companies, for sure, it's also planning to hold the DAT, the preferred share of DAT, for example, ETH and also Solana, to diversify the basket furthermore. However, if you look more closely into the structure of no matter it's Saturn or APYX, you'll realize that the prominent DAT basically backing this protocol are effectively massive Bitcoin holding vehicles. because their corporate treasuries are dominated by BTC. So no matter it's like a SCRC from MicroStrategy or it's like the preferred share from Stripe, the share price and also the credit stability of these companies are highly correlated with the Bitcoin itself. Yeah, so actually, if you think about it, from a structural standpoint, these two protocols, stablecoins, are basically an over-collateralized yield-bearing stablecoin backed by the BTC. But there is also a major catch. Unlike native DeFi lending market that use like the BTC directly, Saturn and APYX also introduce another company level risk. You are not just exposed to the price of Bitcoins, but you are also exposed to TradFi company risk, for example, like operation, geopolitical risk, also like the regulatory risk. So this includes like management decision, like how corporate debt loads, and also like the any kind of like idiosyncratic risk against the specific equities that is actually issuing and backing the stablecoins. So Saturn and APYX reacts a very sophisticated bridge between the public equity market and also decentralized finance. But investors like us, we must recognize the trade-off. We are actually accessing the yield that is pretty high given the current DeFi standard, which like on average the borrowing cost and also lending price is only around 3 to 4%. On top of that, the yield is actually non-correlated with the broad DeFi market. So it means that if you want to loop it, if you want to LP it, even when the market is trending lower, you are still getting like this level of APY. So it's very different from the private credit yield-bearing stablecoins such as like USDT. But the trade-off is very clear. We are also being exposed to another layer of risk from simply exposed to the BTC price volatility. We're also being exposed to that corporate level, the risk, operation risk, like geopolitical risk, and also the financial market risk and regulatory risk.